What are the pros and cons of taking out a 401k loan? What is a 401k loan? And does it make sense to take out a 401k loan to pay off your high interest debt like credit cards or personal loans? And how is a 401k loan going to give you liquidity now and how to repay it? Is this going to hurt your 401k in the long term? So let me first briefly explain what a 401k loan is. A 401k loan is actually not a true loan like a personal loan or student loan. You're not borrowing from a lender or a bank. Instead, you're borrowing from your own investment inside your 401k. Now, I'm going to say 401k throughout this video, but the concept of the loan is the same with 403b, 457, and TSP. But just to keep things simple in this video, I'm going to say 401k. Make sure to talk to your broker that manages the employer-sponsored plan to find out the specific rules if you decide to take a loan out of your retirement investments. Now, you may be thinking that you have to pay interest on the 401k loan. You are correct. But the interest charged on the outstanding loan balance is actually repaid right back into your 401k. So basically, you're taking out a 401k loan with an interest that goes right back into your 401k. This concept is entirely different from a personal or student loan because you typically borrow money from an institution that counts on you to pay the interest to make their money, right? But the 401k loan is the money that you invested, so you're essentially borrowing money from yourself. But make sure you don't confuse a 401k loan with a 401k withdrawal. A 401k loan is you're borrowing your money with a maximum of $50,000 or up to 50% of your total portfolio, whichever is less. And typically you have up to 5 years to repay it with a relatively low interest rate. The 401k broker is not required to do any credit check on you because again, you're borrowing money from your own investments. A 401k withdrawal, on the other hand, is where you sell your investments and transfer the money to your personal checking account. If you make an early withdrawal from your 401k, the IRS will charge you a 10% penalty, federal income tax, and state income tax in certain states. You don't want to do that. So if you withdraw $50,000, expect to pay around 35 to 40% in taxes and penalties. Not only are you going to miss out on the investment returns for $50,000, but you're also going to lose $20,000 out of that $50,000 to the IRS. So let me give you an example. Let's say you have $50,000 invested in your 401k. The IRS allows you to borrow up to 50% of your vested 401k retirement savings with a maximum of $50,000. So if you have $100,000 or $200,000 vested in 401k savings, your maximum loan amount is still $50,000. But in this example, let's just say it's $25,000. Your 401k broker will also charge you origination fees ranging from $50 to $100. Some 401k brokers will charge you a maintenance fee that can cost you $25 to $50. So if your loan is $25,000, your fees are only 0.4%. However, if your loan amount is smaller, like less than $10,000, then the percentage of the fees is a lot higher. So keep that in mind. Are you going to owe taxes on the money you borrow? No. You do not, because this is considered a loan and not a withdrawal. However, if you borrow money from your traditional 401k, which you contributed in pre-tax dollars, now your payments will need to be in after-tax income. And when you retire, you're gonna have to pay taxes again on the traditional 401k distributions. And how is the interest rate going to be calculated? The interest rate for a 401k loan is typically a lot lower than other types of loans, but because the broker is not required to do a credit check on you, your credit scores are not going to be affected. But the 401k interest rate is typically 1 to 2% above the prime rate. If the federal funds rate is 5.25 to 5.5%, then the prime rate is the Fed funds rate plus 3%. So 5.5% Fed funds rate plus 3% is 8.5% prime rate, right? The 401k broker is going to put an additional 1 to 2% above the prime rate. So if the prime rate is 8.5%, then the broker could charge you 9.5 or 10.5% for your 401k loan interest rate. And because your 401k loan is in fixed repayments, whatever interest rate that you lock in at the time is going to be the interest rate you're going to be charged throughout the term. So if you get a loan today for 10% for 5 years, you're going to have to pay the 401k loan back to yourself with a 10% interest rate for the next 5 years. If the Federal Reserve decreases the Fed funds rate at the next FOMC meeting, the prime rate will decrease based on the Fed funds rate plus 3%. But remember that if you already have a 401k loan with the interest rate already locked in at 10% and the Feds decide to lower interest rates, you're going to be stuck with the 10% interest rate. So if you took out $25,000 with a 10% annual fixed interest rate, you're going to put an extra $6,800 back into your 401k, not to the 401k broker. And some 401k broker will give you a discount regardless of the prime rates. This is my screenshot from my thrift savings plan or the federal employee version of the 401k. At the time I'm recording this video, the interest rate for my TSP loan is 3.875%. And how is this going to impact your 401k portfolio? This is going to depend on your 401k broker. I took out a 401k loan back in 2013, but the plan did not allow me to make any further contributions until the loan balance was repaid in full. This was due to the fact that I elected to take out a hardship 401k loan at the time. However, if I had taken out a loan to pay for a house or other general purpose, then my 401k might allow me to continue contributing to my plan. Again, you need to contact your 401k plan to find out what the rules are, because some plans will not allow you to make any further contributions until you repay your loan. Also, your 401k loan repayments are not considered contributions. So if your 401k doesn't allow you to make any contributions while you're repaying the loan, you could potentially miss out on the employer match if your employer provides one. Missing out on the employer contribution could cost you tens of thousands of dollars, if not hundreds of thousands of dollars in 20 or 30 years. And by taking out $25,000, you're going to miss out on investment returns on the money you borrowed. You could argue that the 401k loan interest rate will be repaid back to your 401k, but when we go through a massive bull market year, your portfolio could really hurt in the long term. And let me show you my 401k loan calculator, which you can download for absolutely free by visiting firesightcheck.com/resources. For every example, it's going to be $25,000 in total loan amount with a 10% interest rate for 5 years. This example is if your 401k loan or plan doesn't allow you to make any contributions when you have a loan open with a broker. With the loan of $25,000, your annual repayments will be $6,374 or about $530 per month with a 10% interest rate. So theoretically, your $25,000 will have a 10% return right back into your 401k, and your 401k could continue to grow with an 8% average annual return, ending with $77,000 by year 5. Again, this is assuming that your 401k plan doesn't allow you to repay your debt and contribute to your plan at the same time. And what if you don't take out a 401k loan at all and you continue to contribute at the same amount at $530 a month using the previous example? If your employer contributes $3,000 a year into your 401k, then by the end of year 5, you could have almost $133,000 with an 8% average annual return. So if you take out a 401k loan and the plan doesn't allow you to contribute while you're on the repayment plan, the opportunity cost that you could lose out is $56,000 in just 5 years. And that's with the employer match. But what if your 401k allows you to continue contributing to your 401k at the same time you repay the loan? Using the same scenario, I'm going to repay my loan in the amount of $6,400 a year, and at the same time, I'm going to contribute the same $6,400 a year as personal contributions. This also comes with an employer match of $3,000. So by year 5, when I pay the loan in full, I'm going to have $136,000 with an 8% average annual return, which is only $3,000 more than the previous scenario at $133,000. But as an experienced financial coach, most people who took out a 401k loan end up not making any contributions while they're repaying their 401k loans because they're already living paycheck to paycheck. So most people end up in the first scenario and potentially lose out on $50,000 or more in opportunity cost, depending on the size of the loan. And keep in mind that this scenario was just a $25,000 401k loan. If you need help with your personal finances, like your 401k loan, you can schedule a 20-minute complimentary financial coaching session by visiting firestitcher.com/coaching. So when should I or should I not take out a 401k loan? If you're planning on using your 401k loan to increase your lifestyle expenses, don't do it. You're gonna lose out on potential investment gains in the long term. It is not worth it. You need to leave your retirement accounts alone and let them do the work. If you're going to quit your job soon, don't do it, because some 401k plans will require you to repay the loan in full in a shorter period of time. Some 401k plans will be reasonable, but you won't be able to move your 401k to another 401k or IRA until you settle your loan first. If you're going to take out a 401k loan, make sure that the plan allows you to continue contributing to your 401k like I showed you in the spreadsheets. If not, it's gonna hurt your portfolio in the long term. If you decide to take out a 401k loan, you need to repay it on time and in full. If you can't repay it and you end up defaulting on your own 401k loan, the IRS will treat it like an early 401k withdrawal and charge you a 10% early withdrawal penalty, federal income tax, and state income tax. Don't bite more than you can chew. If you can't afford the monthly payments, just don't do it. And if you have multiple credit cards or other high interest debt that is drowning you right now, then the 401k loan might be an option. However, I caution you that taking out another form of debt to pay off your debt may not solve the root cause of your debt problem. How did you get into high interest debt in the first place? Do you spend more than you make? Because if you don't solve that problem first, you're gonna end up taking out a 401k loan again to pay off your credit cards and then spend more money thinking that you have money in your account when you really don't. But there are options other than the 401k loan. And I understand that some people can be in a unique situation where they need a large sum of cash right away. If I'm in an emergency situation, I need the cash right away. And I'm gonna use my emergency fund first before I even touch my 401k. This is why saving 3 to 6 months of expenses is ideal for your emergency fund. And if I end up depleting my emergency fund, the next one I would tap into is my taxable brokerage accounts. The most I'll pay is 15% of capital gains tax anyway, and I can always rebuild my taxable investments. And if I don't have a taxable brokerage account, then I will use my HSA fund if it's got something to do with my medical, dental, or vision. And if I don't have an HSA and I need cash for emergency use, the next one I would look at is my Roth IRA. And keep in mind that you can withdraw your Roth IRA contributions at any time, tax-free and penalty-free. You just can't take out the interest in earnings that accrued inside your Roth IRA. If I have absolutely no other options, then the very last resort is to take out a 401k loan. And before I get into the pros and cons, have you noticed that I never mentioned taking out additional debt? It has to be my very last resort if I completely deplete my cash savings. But if you're the type of person living paycheck to paycheck, then you need to re-attack your spending habits first. Why are you spending more than you make? Could it be a spending problem or an income problem? Otherwise, you're gonna be in an endless cycle of debt after debt. And here are the pros and cons of a 401k loan. This is not the same as a 401k withdrawal. You're not gonna be penalized or taxed for taking out a 401k loan. The interest for a 401k loan will be repaid back into your account. You're basically acting as your own bank or borrowing money from your own portfolio. So if you miss out on 1 or 2 payments, your credit scores won't be impacted. The broker won't even check your credit scores because you're essentially borrowing from your own account. And the interest rates are relatively lower than personal loans and other lines of credit. Borrowing from your 401k is financially smarter than taking out more credit card debt, payday loan, or high interest title loan. If you have high interest debt like credit cards, or you need the money to pay back taxes owed to the IRS, then a 401k loan might make sense if you have no other ways to repay it. And here are the cons of a 401k loan. If you leave your job or get fired by your employer, your 401k plan will ask you to repay the loan in full. And I've seen some brokers that give you a few months to repay the loan. However, most plans will require you to repay the full unpaid loan balance all at once. And if you can't do that, the IRS will treat it as an early distribution, penalize you for 10%, and charge you additional income taxes. And if you need to leave your job, make sure to have a plan to repay your 401k in full. You don't want to pay 30 to 40% in taxes for that, right? And the next con is double taxation with a traditional 401k. The $50,000 you borrow from your traditional 401k was in pre-tax dollars, but you have to repay your loan in after-tax dollars. So if your effective tax rate is at 20%, you're essentially paying 20% in taxes to repay your 401k loan. And when you're retired, you're gonna have to pay taxes again on the 401k distributions. And if your 401k doesn't allow you to make any contributions while you're repaying the loan, you could potentially miss out on the employer matches, because the employer match only happens if you make personal contributions, right? If your 401k doesn't allow you to contribute to your 401k at the same time you repay your loan, then you could miss out on thousands of dollars on the employer match. And if we're in a high interest rate economy, keep in mind that a typical 401k loan adds 3 percentage points to the prime rate. If you lock into a high interest rate with a 401k, that's what you're gonna be stuck with for however long your term is gonna be. If you get an 8% interest rate, you're stuck with 8% for the entire term because it is a fixed interest rate loan. Your minimum payments could potentially be a lot higher. So do you have a 401k loan? Let me know in the comment section down below why you have one. And I had a 401k loan in the past, but my plan didn't allow me to contribute at the same time I repay my loan. That was a huge mistake I made because I missed out on my retirement contributions and compound interest. I potentially set 3 years back from retirement because I was being irresponsible with my spending. And I've been on my financial independence journey since 2016. Now, am I gonna take out a 401k loan to build my wealth? Absolutely not. I'm always gonna have cash set aside for emergencies. My income streams are well diversified now, so I don't need to worry about losing one income source to pay my bills. No one on the FIRE journey will ever say that they're gonna leverage their 401ks to grow their wealth. No one. Leave your retirement savings alone and let them do the work for you. You can build your wealth by diversifying your income sources in so many other ways. And I encourage you to download all of my financial resources for absolutely free by visiting firesuccess.com/resources. And if you need help with your personal finances, I encourage you to schedule a free 20-minute coaching session with me by visiting firesuccess.com/coaching. And if you want to know if a HELOC is a good idea, or if you want to know about the special early withdrawal rules for the Roth IRA, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.